Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Just seconds away from the open of trading. We're clawing back some of the losses from earlier this morning with the S&P and NASDAQ down about 1%. The shift has really come in the bond market. When you take a look at 10-year Treasury yields, they actually were higher earlier in the session. Now they are lower, 3.70%. This perhaps is a flight to havens, and it could be its duration. That's given a little bit of support to the equity markets, and you are seeing the euro continue to decline. 97 handle. Just shocking to see some of the reversals of the past few decades. And crude falling below $80 a barrel on the WTI index. We're looking right now at $79.40. Joining us now with a look at the stocks moving ahead of the opening bell, I should say. Here is Abigail Doolittle.
Hey, Lisa. Well, any way you slice and dice it, it's bearish. We might be off the lows a little bit, but we are looking at stocks down for a fifth out of the last 6 weeks. Really pretty bad near that June low. The question will be, will that low hold? Right now, some big movers to the downside. NVIDIA down 1.2%. Now the stock's down 40% from its all-time high. Morgan Stanley right now saying an even greater pervasive correction is going to hit the chip. So NVIDIA, a big bellwether there. JP Morgan Chase, even with yields coming in a little bit at this point, it is down on that, but that 2-year yield higher. So despite the action in yields, that conundrum we've seen all year. Chevron, like other oil giants, down 3.2% as oil, WTI crude, breaches that $80 mark at its lowest level since January. And then finally, any metal that I look at here, Lisa, on the Bloomberg terminal, whether it is palladium, platinum, gold, along with copper, they are down. That means Freeport-McMoRan is also down. That metal and miner, rough day, rough week, rough year.
Abigail, thank you so much. Tech stocks extending their declines as rates keep moving higher. Bloomberg's Ed Ludlow here in the studio with us. Ed.
Yeah, morning. We're down a percentage point on the NASDAQ 100 and on the Philadelphia Semiconductor Index. Notable declines in most of the mega caps, dragging down the NASDAQ 100. We're heading for a second consecutive weekly decline on the NASDAQ 100, fifth decline in 6 weeks. But I'll give you a little bit of hope because it's Friday and I like to be an optimist. We're not seeing the declines that we saw last week following that CPI print. This is the story, right? Bring up this terminal chart. You look at the push higher in real yields, the decline in the NASDAQ 100. There's a portion of the market that would say valuations have come down. Now might be a good opportunity to buy, but it's hard to call a bottom when you continue to see those real yields push higher. There is also a pocket of pain in the market, and that is semiconductors. Semiconductor declines on a year-to-date basis far outweighing that of the NASDAQ 100, but it's also where we see the majority of earnings revisions. And as we move away from this higher rates narrative to one about global growth, it's really the pain in the semiconductor industry that's to come that the market seems to be worrying about. Happy Friday.
Ed Ludlow, thanks for the note of, I guess, optimism. What started as a mild sell-off this month has morphed into a deepening interest rate spurred rout, wiping out virtually all of the gains that we saw in equities this summer. Kaylee Lines joining us back for more fun. Kaylee.
Well, Lisa, I'm not really sure it is a happy Friday, at least if you're invested in a lot of these different assets, and it really hasn't been a happy year. It seems really the only place anyone wants to go is cash or to the U.S. dollar, because certainly in the bond market, Ed was just talking about that higher rate story. We have to put this move in context. The move in yields marking a significant break of the long-term downtrend we have seen in rates. And when I say long-term, I mean 35 years. We have finally seen a shifting of the tides, though, as yields move up, price down. It seems like the great bond bull market is now firmly a bear one. And of course, those higher rates, as Ed was saying, have taken their toll on equities. He was talking about kind of tech as a basket, but imagine being a profitless tech company in this kind of environment. They have taken the most brutal punishment of all. A basket of those stocks down 54.5% on a year-to-date basis. That well outpaces the losses we have seen for the NASDAQ 100 or S&P 500, though of course those losses also are substantial. And it used to be amid all that carnage in stocks and bonds, you could at least count on some insulation in the commodity market. But as the narrative shifts from one of constrained supply to now weakening demand, that has changed too. Copper, for example, down 30% over the last 5 months. Copper prices down once again today, along with oil prices. You mentioned it earlier. We're looking at a 79 handle on WTI. So you can't buy the commodity market, you can't buy the bond market, you can't buy the stock market. I guess that leaves you with the U.S. dollar and cash. Lisa.
Kaylee Lines, thank you. I guess it's very happy day. Goldman Sachs slashing its S&P 500 year-end target to 3,600 from 4,300. Strategist David Kostin writing, quote, the expected path of interest rates is now higher than we previously assumed, which tilts the distribution of equity market outcomes below our prior forecast. This seems to be a theme across Wall Street. Bloomberg's Taylor Riggs joining us now with more. Taylor.
And Lisa, those higher rates are impacting not only the price, but also sort of those PE multiples. Let's walk through the math that Goldman does when they migrate downward to about a 3,600 on the year-on price target from a previous estimate of 43. The higher discount rate, you know the math, the higher the input, the lower the present value. It also means you migrate downward to about a 15 times on the PE basis in a ratio relative to 18, which it was before. The economist David Kostin, of course, the equity strategist, saying that the economists are now looking for 75 in November, 50 in December, 25 next February. Peak rates means lower price. And you've really seen sort of the migration downward as we're rethinking the path of this Federal Reserve and really here the higher the interest rate. So we've gone from about a 48 earlier in the spring, a 46, 44 this summer, and then the last about a 4,300 is where we are now when we think about those year-end price targets. Public agrees, and this is sort of a similar point that Kaylee was making as well. If you want to go into a one-year CD, you're getting 3-4%, king dollar, so why not? Maybe a risk-free cash is king.
Taylor, thank you so much. Keith Lerner of Truist expecting markets to remain volatile, writing, quote, we expect this choppy and challenging market to continue. Recession probabilities are very high. Even if inflation slows, the scar tissue left behind at the Fed due to the inflation challenges of the past year should not be understated. Keith Lerner, I am so happy to say, is joining us right now. Keith, how much, especially as we look at king dollar, as we look at real yields on 10-year treasuries climbing to the highest going back to 2011, how much can you really lean against that trade versus just pile in with the rest of the investors?
Well, first, great to be with you, Lisa. It has been an extraordinarily challenging market. You know, our view since early this year is, you know, we started to become more cautious up in quality really since February. And, you know, before Powell's speech, you know, the market was around 4,200, and we thought the market was pricing in this kind of soft landing, which we thought was really, it didn't make a lot of sense. So, you know, at this point, though, I will say, I know everyone's negative. The numbers today, the futures are looking very negative. You know, we're down 13% in about a month, so I don't know that it makes sense to become more negative here. We still are positioned for more of that choppy, challenging market. But again, we're down 13%. Markets don't move in a straight line. Sentiment is becoming a bit one-sided. And what we've seen this morning so far is, you know, as rates have come in just kind of a little bit, you know, seen a little bit of stabilization in the overall market. And we do think, you know, that there is now value in fixed income. And, you know, for the last decade, that's not something we could really say. So it may overshoot, but it's really about time frame, especially for folks that have, you know, 2, 3, 4 year time frame. The fixed income side in particular is starting to look a lot more interesting.
Are you buying anything today, Keith?
You know, we're not day traders per se, so, you know, again, we have changed. When the market was on 4,200, 4,300, we actually reduced equities. I think what we're looking at more right now is the opportunity in fixed income. So we're not doing anything per se today, but I do think the fixed income side is becoming more attractive. And again, look at the 2-year yield. You just talked about it before, above 4%. You look at the year-over-year change in the 2-year, that now exceeds the change we saw in 1995. And with all this global bank tightening, rates may continue to overshoot, but ultimately that's going to weigh on economic growth. And we think as we look into next year, that's going to cap the upside in rates, even though we are having an overshoot. You know, Lisa, what's interesting is these moves in these markets would tend, which historically we would expect to happen over years, are happening over, you know, weeks now, or even sometimes feels like days. So things are just moving a lot quicker today.
So Michael Hartnett over to Bank of America weighed in on the bond crash that we've seen over the past 6 or 9 months, writing, quote, inflation rates, recession shocks are not over, plus bond crash in recent weeks means highs in credit spreads, lows in stocks are not yet in. Investor sentiment unquestionably worse since global financial crisis, and possibly worse than even then. From your vantage point, when you talk about fixed income, how isolated is that to treasuries and not necessarily to credit?
Yeah, we would certainly be focused on high quality kind of government type securities because if we do go into a recession, high yield spreads, which have hung in there actually relatively well, are not priced for a recession. So we would stick up. You don't need to take if you're getting a 4% yield in the 2-year or something approaching 3.75 in the 10, we don't think it makes sense to take that credit risk. And I think this sharp move in rates, how quickly it has moved up, really increases the risk of recession. And in that environment, you don't want to take on a lot of credit risk in our view.
How much is your view on the equity stance going to be dictated by earnings? Is that really relevant, or is this a real macro story at this point driven by rates?
No, it is relevant. I mean, the earnings have held. They also have held in, relatively well. And I think what happens right now is, if you look at the overall S&P, the PE is about 16. If you look at the equal-weighted S&P, which is the average stock, it's about 13. But that's probably doesn't take into account that earnings still need to come down. So stocks have revalued lower. They're cheaper, especially someone looking at 3, 5, 10 years out. But they're not at a compelling valuation relative to this, really challenging macro environment. The other thing that's interesting is, one thing we look at is this equity risk premium, right? The earnings yield relative to the Treasury market. And even though stocks have come down, since yields have moved up so quickly, the relative appeal of stocks is not as attractive. Actually, has moved down in the way we look at this as far as what that means for forward returns. So again, I think it's where we are overall is still be somewhat defensive. Sector positions, staples, utilities, healthcare. I mean, we still like energy. But, I think there will be an opportunity to become more on offense. We're not there yet. But the last thing I'll say, Lisa, just short term again, we're down 13%. I don't want to just, pile on to all the negativity on a short-term basis when we're down 13% in a month. That's a pretty extreme move that we've seen already, and we've seen that, once you hit a low, a short-term rally can move pretty quickly the other way as well.
I appreciate that, because it's so easy to get caught up in a certain hysteria and the emotional aspect of the bear market, as Julian Emanuel put it. Before we let you go, though, or before we move on, I do want to get your view when it comes to earnings, how the pound, how some of these currency moves, how the fate of the rest of the ex-U.S. world is dealing with both the inflationary aspect as well as the difficulty in fighting a reverse currency war. How much are you looking at earnings of U.S. companies getting detrimentally affected by a European region and a United Kingdom absolutely flat on its back?
No, it's certainly one of the big risks to earnings, and that's why we think they have to be reset lower. But I will say, when you look globally, we've been long-standing bulls on the U.S. market. We call it the big blue chip country. And you think about the fragility of these overseas markets already before this. You had economies that were almost growing, less than 1%. With this inflation, with interest rates, with the energy problems, we have in our guidance portfolios, we have zero allocation to emerging markets, and we're about a third of the allocation to international developed markets. That's not a new stance for us. That's our position for some time now. So we would still say, even though there's some concerns on the multinationals, stick with the U.S., the big blue chip country, stick up in quality, and have more defensive sector position within that allocation.
Keith Lerner, you're going to be sticking with us. Coming up, bond yields surging as central banks around the world hike rates. That conversation still ahead as we pair some of the losses from earlier, but still deeply negative after an already negative week. Amazing to think we're down 13% in just a couple of weeks as we reassess the commitment of this Federal Reserve to hike rates. This is Bloomberg.
we think at a minimum the Treasury curve will be at about 4.5%. That's a 12% yield with credit spread and where the Treasury curve is. That's substantially above the 8.5% now. So there's a lot of impatience in the market to take advantage of the repricing. We're not even in the recession yet. Let's wait till we get there.
That was Bob Michel with some pretty scathing comments for the prospects for credit returns over the near term. Global bond yields surging amid a global rate hike frenzy this week. Central banks around the world trying to crush inflation, even as they run the mounting risk of driving their economies into recession. This has been the issue of rising into weakness. Right now, we are getting some data, both Michael McKee and Kaylee Lyons both joining us to give us more perspective. Mike, some data just crossing having to do with industry. What's the latest there?
Well, these are the S&P Global PMIs. They are released around the world today. And in the U.S., a bit of a surprise. Manufacturing rises 51.8 from 51.5. Don't know the reason for that, but it is a bit of good news, and it remains above the 50 level, which signifies expansion. Services, however, dropped to 49.2. That's an increase, actually, from 43.7 the month before, but it is still below contractionary territory, and the composite at 49.3 is also up from 44.6 last month. So a little bit of improvement in the U.S. economy. It's kind of hard to relate to the rest of the world when you look at the others that came out today. Germany, France, the Eurozone, and UK. France had decent services numbers, but a lot of 40s on those boards, and it does show that Europe is pretty much headed into, if not already, in recession. Interesting comment today, and maybe Kaylee has more on this, from the folks at BMO saying that the data don't matter anymore. It's really what the Fed and the other central banks say that people care about, because it's all about inflation.
Well, Michael McKee, thank you. And we are seeing right now a little bit of a response, yields going even higher in the 2-year. Keely, this kind of speaks to what we've been seeing and speaks to the strength of the U.S. being bad news, at least when it comes to short-term rates.
Yeah, and that's definitely a story in the rates market. It's one in foreign exchange as well, because I would argue, how much do even other central banks matter as long as the Federal Reserve is hiking and keeping the dollar strong and everything else weak? But on the subject of the bond market, I have said this multiple times today, I keep questioning myself as to whether I'm actually looking at an intraday chart, because some of the intraday moves are absolutely wild. We are up 39, call it 40 basis points on the 2-year gilt yield in the UK, 47 basis points on the 5-year, after we got the outlines of the fiscal policy plans of the new government and the borrowing that is going to have to come with it. That, of course, is the standout, but this is a global story. The 2-year yield in Italy up 15 basis points to 2.956, and of course you're seeing it in treasuries, as you said, Lisa. And while I say I can be astounded by an intraday chart, I also can be astounded by a longer-term one, because taking a look here at a year-to-date chart of the 2-year Treasury yield, we're up 340 basis points on the year, and 125 basis points of that has come just since the beginning of August. The pace of these moves is remarkable as we rush to reprice our expectations of a hawkish Federal Reserve and really central banks across the board. Of course, what that all adds up to is a bear market in bonds. The Bloomberg Global Aggregate Index is down 20% from its peak. I'm sure there are a lot of investors out there that could use a big bear hug right now.
Kaylee Lyons, thank you. So with us, we're so lucky to have Keith Lerner. Keith, thank you so much for your patience. As we watch real yields continue to climb, as we see central banks hiking into weakness, are there certain thresholds you're looking for to determine how to shift, or that perhaps the time is to perhaps get a little more aggressive?
Sure. I mean, the first thing is we have seen sentiment, what people are saying, being pretty bearish, but we haven't seen that follow through as much in some of the technical indicators, like the put-to-call ratios. The equity flows this year have actually been pretty benign. I think a little bit of more aggressive on that side would be helpful. I mean, you certainly want to see also maybe a shift under the surface where you start to see some of these cyclical areas of the market show stabilization. And of course, you need to see interest rates stabilize. I mean, that will be, all important. But let's also put some context about where we're at, because again, we are more, on the cautious side, when we're looking at, let's say, the next, 6 months or so. But from a long-term investor's perspective, is for the first time in a decade, you actually are getting compensated for fixed income, right? So in a balanced portfolio where everyone was, having to take more risk because there was no return, when you look out, you're actually going to get better compensated. So that's a good, even though we have to take this short-term pain. So I just think, in days like this, and a lot of, the viewers that aren't just investing for the next several months, who are investing longer, it just makes sense to have that backup. The other thing is, we looked back historically and said, hey, if you bought the market when you're down 20%, since the 1950s, 3 years later, you're up, with strong gains the majority of the time. But that didn't preclude some short-term weakness over the next year, especially if you go into recession, which is still our base case. So I think that is helpful. And then lastly, maybe, around recessions, the median declines about 24%. The average is about 30%. So we're over 20% already. Doesn't mean you can't overshoot, but I think, it's also helpful to have some context, with the overall picture.
When you talk longer term, 3-year, 5-year, 10-year horizon, how much are you discounting some of the theories out there right now that we're going to have a prolonged lost decade of earnings or a lost decade of returns in stocks?
Well, I think what's different going forward is, one, we do think returns will be somewhat higher, so we don't think it's going to be a lost decade. But I do think with the scar tissue mentioned in the beginning of the show, our view is that the Fed has scar tissue, and the next decade it will likely be a lot different than the last decade. It's not just a buy and hold market. You have to be somewhat more tactical. Part of the reason why we had all these V-shaped recoveries in the market is because the Fed was on perpetual call. They didn't have to worry about inflation in the last decade. Remember back in 2008, 2009, all the money printing, everyone kept saying, oh, there's going to be inflation, there's going to be inflation. No inflation showed up. Well, this time is different. So what that means going forward is that not only is the Fed staying higher for longer, when they eventually do ease, they're likely to be not aggressive, and they're likely pull back sooner. So that means to us a more volatile and tactical environment. And that's what we've been doing this year. We've made over 5 tactical shifts in some of the portfolios we manage directly, these big asset allocation portfolios. So I think the mindset has to change a bit, and that's a wake-up call.
Keith Lerner, thank you so much for taking the time on a pretty active day, to say the least. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. About 24 minutes here into the open. The red's still there. People still risk off as we take a look at the prospect of perhaps a more aggressive Fed, deepening losses. The Nasdaq down 1.7%. This is Bloomberg. Bloomberg, the open about half hour into the trading day, and the pain is just getting deeper. The S&P down nearly 1.7% as people reconsider the Fed's rate path and what that will unearth onto this particular economy. We're also seeing yields higher on the front end. Time now for the trading diary. What you need to be watching through the next week. Italian elections on Sunday. Ton of Fed speak on the calendar, including President Bostic, Mester, Evans, Daly, and Chair Powell on Tuesday. ECB President Lagarde on Wednesday. GDP and initial jobless claims in the U.S. on Thursday. More Fed speak from Williams and Brainerd to wrap the week. This was Countdown to the Open. This is Bloomberg.
Day like Bloomberg. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
All right, we're 30 minutes into the U.S. trading day on this Friday, September 23rd. Here are the top market stories that we have for you at this hour. It's UK tax cuts just crashed the markets. Liz Truss's government outlines a radical tax cut package and more government borrowing. The market's priced in a 100 basis point hike from the BOE. Traders race to reprice risk. And we're seeing epic bond market declines. UK rates climb as much as 50 basis points, triggering a sell-off in global bond markets. European stocks enter a bear market. Traders rush into the dollar again. And a retest of the June lows. Goldman, the latest strategist to cut its forecast. We try to find some technical levels as investors look to that retest of June lows. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. This has been a really tough week for markets, and it doesn't look like it's getting any better. I mean, I've never seen moves like this before in a bond market.
Yeah. It is Friday. We should all be glad it's Friday, I think. A little bit of a moment to pause and maybe think about what is going on here. I'm looking at a cable rate that is now trading at 110.10. Potential test of 109 imminently. We're at session lows. We're down by 2.23. Alex, 2-3%. The 5-year is epic. This has been a week in which it's just been a drumbeat of bad news for risk assets, in the form of the Fed, in the form of the data, in the form of the fiscal event that we just had here in the UK. It has all come together and snowballed, and that is what we're seeing at the end of the week.
Yeah, and no one seems to be immune at this point. You are seeing some safety moves, like I mentioned, into the dollar and now in the back end of the bond market. But even that, you have to think about how you're going to price that if we wind up going into some kind of recession here within the U.S. with the Fed continues to hike rates. But now and today, it really is about the UK, and I'm reading note after note about the characteristics that the UK now has with emerging markets and why we're seeing the fervent capital outflows from different assets in the country.
Absolutely. But the UK is just front and center in this today. Other markets have taken center stage throughout this week. You've got an energy crisis that is evolving in Europe. You've seen what has been happening with Vladimir Putin and his nuclear threats. You've got, obviously, the Fed in the mix as well, and central banks broadly. The amount of tightening we've seen this week has been eye-watering, Alex. So it has been unbelievable to put this all together into just a few days and get the kind of market reaction we're getting. I look at the pound, 110.09. We're pushing lower and lower and lower as the day progresses, down 2.25%. Is it time to take profit on that trade? I don't know, but there's certainly notes beginning to float around about that. Look at the UK 5-year, a 45 basis point move. This is I can't remember seeing these kinds of moves, and we certainly haven't for decades. How does the Bank of England respond to this? The 250, probably a more accurate gauge as to what is happening here in the UK rather than the FTSE 100, down by 2.14%. And that is on a day, there's still some translated earnings effects into that. That is on a day when the currency has gone down. In theory, you should be valuing even the 250 a little bit more richly, because if you have the translated earnings effect in, that should benefit the UK and in theory make UK businesses more competitive. And they've got some big tax gains today, but that's not the way it's playing out here, Alex.
Yeah, here in the US, Guy, we wanted to highlight as well. I mentioned that June low, right? That 3666 level. We are just about 20-30 points away from that right now within the S&P. We're off almost a full 2 percentage points. And as you pointed out, you had the Fed, you had other central banks hiking rates, energy crisis, and then the UK was like the icing on the cake for that. Energy is the hardest hit within the S&P as oil really rolls over now. Brent just in the high 80s. And I mentioned where the money's going. Bank of America took a look at the data, and just through Wednesday, $30 billion moved into cash. You can just imagine then what happened over the last 48 hours. The 30-year now up by 1 basis point. Money going into there. The dollar continues to make new highs. And you have to, it's like there are no charts for this right now in what we're seeing. And how do you catch a falling knife? And where do you hide out until we settle up?
Well, I hope there are charts, because we're about to talk to a technical analyst. So I'm hoping that we will find out a little bit maybe as to what we can learn about where we're going from that conversation. The risk route certainly intensifying. It has been a snowball, as I say, that has just been gathering momentum and size throughout this week. Here's what our guests have been saying about what we've just seen.
The market has been bad.
We're very much in flux now.
We have weakness across the world.
The animal spirits feel crappy.
The global world is slowing.
Numerous different headwinds, whether it's around growth.
Inflation.
Core inflation is looking sticky.
Geopolitical risks as well as a hawkish Fed.
You name it. There's a tremendous number of pressures.
The headwinds are too much.
There could be further downside.
I'm overall bearish on risk.
Sentiment and positioning will become so extremely bearish.
We're dealing with an uphill battle here.
Let's talk about where this leaves us. From a technical point of view, there's lots of fundamentals to think about here, but at times like this, when you see these very whippy markets and big levels potentially being broken, it's often useful to try and use technical analysis to gauge sentiment and where we are. Richard Ross joining us now, head of technicals over at Evercore, to give us a take on what is happening here. Richard, let's start off and talk about what is happening with the equity markets and the bond markets. Give us an idea of what you're seeing, first of all, in equities.
Yeah, well, look, I think I'm seeing what most people are seeing, which are some extreme moves across asset classes. And clearly what's driving the action in stocks is the clear erosion, these historic moves, if you will, from the top down across both currencies and credit. And here we are testing the lows of the year on the S&P around that 3666 that you alluded to earlier, and the DAX and the CAC again flirting with, if not breaking just below those year-to-date lows. So clearly this is a critical inflection point for global markets.
For the S&P, where's the next level of support before we get to the June lows? Is there one?
No, I think you're really there. You know, what I've been saying in conversations is that in fast-moving markets like this, there's no real difference technically, and I don't mean to be somewhat glib about it, but there's no difference technically between 36.93, 36.66, and even 36.20. Again, not to spend our viewers' money, but only to suggest that we're talking about 20 minutes of price action at this point in sort of an historically volatile tape.
Richard, just staying with equities for a moment, how low could we go? If you take a step back and look at where the charts are right now, can you make any longer-term predictions about the unwind that we're seeing? Where does it ultimately, do you think, take us?
Yeah, I apologize. I didn't mean to speak over you there. I think what I've been using to help guide me, and it certainly hasn't been helping that well, is the longer-term charts. And when you look back at whether it's a long-term weekly chart back to the financial crisis in '08 or a longer-term monthly chart to sort of smooth out some of that volatility, what we see is that remarkably that longer-term trend is still intact. The 200-week comes in around 35.85. The 50-month comes in around 35.25, 35.50. So again, we're within about 100, 150 handles here. Let's call it 300 to 500 basis points before we start testing those really critical levels of long-term support. My contention is if we're able to hold those levels, then again, while it sort of flies in the face of reason, the bull market will remain intact if we can hold those levels. And again, if we do breach those levels, which have not been breached going back to 2009, then it opens the door to further downside. But that's not my call at this juncture.
Okay, so Richard, how much does the 2-year need to top out for us to not make new lows here and to make that June low really the bottom?
Yeah, I think it's all about interest rates and the dollar, and they're two sides of the same coin, no pun intended. And what we see in interest rates, again, is a chart that's gone vertical here, and obviously for good reason, or bad reason, if you will, as it pertains to that more hawkish policy, not just here in the U.S., but on a global basis to try to rein in this surge in inflation that we know about. So the key point, bringing it back to those yields, is that when you stare at the 2-year, this is the most overbought in yield that you've ever been, and the chart has gone vertical. So again, we don't stand in the face of a runaway train. You don't catch the falling knife, but we know that things that go straight up and become the most overbought they've ever been have a tendency to come straight down.
Let's talk about what is happening in the energy markets. Clearly there is a dollar relationship here, but there's also a demand relationship here as well. Talk to me about what you see from a technical point of view outside of the fundamentals. Crude coming down pretty sharply once again today, a fairly big move to the downside. How much further does that have to run?
Yeah, I think WTI has been one of the few things that have gotten right around here lately, with some downside to $65. Look, clearly there's been geopolitical concerns, to say the least, which have kept a bid in the market. But by the same token, the chart's been eroding for some time, really in almost straight line fashion from that 125, 130 level that we peaked at back in the summer. Projects measured downside to $65, $70. Again, that stronger dollar is finally coming home to roost in the crude hits, and again, clearly the erosion in demand and the rising risks of a recession weighing there as well. So not a lot to hang your hat on from a bullish standpoint as it pertains to crude. And of course, fantastically, the Ukrainians making some progress remarkably against the Russians. So I think all roads lead to lower WTI prices.
Yeah, and I also wonder, like, how many stop losses have been triggered that need to then, you see other assets and selling off, all that contagion that we worry about in capitulation. Richard, thanks a lot. We appreciate it. Charts are so useful on a day like today. Richard Ross of Evercore ISI, thank you very much. So coming up, we'll get more on the sell-off. Is a soft landing now nothing more than wishful thinking? What do you do on a day like today? We're going to talk to Chief Investment Strategist at Bull Tick Capital Markets, Catherine Rivera. This is Bloomberg.
when the Fed makes its call.
A unanimous Fed raises the benchmark rate 75 basis points.
Bloomberg is there with live coverage.
We anticipate ongoing increases will be appropriate.
The market's responding to this, as you might expect.
And instant expert analysis.
Do we want this Fed to force a recession?
They're saying that forward guidance is dead. It is very not dead.
We keep being surprised at how durable inflation is.
The risk is skewed to doing too much.
They're choosing the lesser of two evils.
Nobody covers the Fed like Bloomberg, your global business authority.
A tighter Fed up until now meant higher longer-term rates. Perhaps, a tighter Fed going forward is going to actually mean lower rates because it means lower long-term growth, lower long-term inflation. Right now, we have probably one of the highest, exposures to cash and cash-like investments that we've had in the history of the firm. Probably about 17% or so of the portfolio is in cash and cash-like investments. And I think, it's a lot, but it gives you a lot of dry powder. It gives you a lot of safety. And again, you also get to capitalize on these higher rates that the Fed is providing us.
That was Dan Suzuki, Deputy CIO at Richard Bernstein Advisors, talking about his firm's cash allocation, which I mentioned before, $30 billion of inflows just through Wednesday of this week. So where do you find safety? Joining us now for her take, Catherine Rooney-Vera, Chief Investment Strategist for Baltic Capital Markets. Catherine, always good to see you. What do you do on a day like today?
I think you have to have already been positioned in value over growth, have a healthy cash position, definitely have some structured products that limits your downside, also limits your upside, but they're products that we've been touting to our clients for some time and able to execute. So certainly, the cash and value, defensives, we're entering a recession. The Fed is hiking into a recessionary environment. So we do need to have positions that can historically outperform in very difficult times like this.
Catherine, what would persuade you to use the cash? What I'm wondering is if we are reaching, how far away from a cathartic moment are we? How far away from this market finding a clearing price do you think we are?
Sure. If we do effectively go into recession, we could see an additional 10% downside in equity markets, and I think that would be interesting to start to add positions and use that cash that we have accumulated on the sidelines. But I think there's more interest, for me at least, in the fixed income market. So we have the 10-year yields, 2-year yields flying, the long ends. Yields are becoming attractive. So if we see the 10-year, for example, go to 4, that's attractive. And I think the long end of the Treasury curve could serve as a nice hedge to risk assets at these levels. So I would start to accumulate, and I think that fixed income, as we move away from everyone talking about inflation, which has been, stagflation is what happened this year. As we move away from talking about inflation, as inflation drops, which it inevitably will, and we talk about recession, the unemployment rate jumping, which is my perspective, I think the unemployment rate is inevitably going to jump. I think fixed income is going to catch a bid, and we need to go out the duration curve and start accumulating in the near term.
Hey, Catherine, we just got a headline here on the Bloomberg. The yuan fell to the lowest level, the lowest closes to the weekend of the PBOC ban since 2015. Just the strong dollar, weak yuan, weak currency story. Is there a play in the FX market?
The FX market moves have been phenomenal today. Fascinating. The dollar has jumped significantly, and that's, of course, because of the difference in interest rate differentials, which I don't think is going to go away in the near term. So let's continue to bank on a few things, Alex, and that is a strong dollar for the near term. That is an inverted and increasingly more inverted yield curve, and I think you're going to get some attraction on the fixed income front. So those, I think, are the near-term trends that are going to continue. The Fed is the place that, to hide. The Fed is going to continue to hike rates. So Treasury, I think, are going to catch a bid. That's going to continue to keep pressure on the dollar and on Treasuries, which I suspect we're going to see rates start to drop by the end of this year.
Catherine, is this an equity market that you can ride out the downdraft? Or is this a market you should, rather than trying to ride out, bail out? Should you be getting out right now? Should you be selling?
Yeah, I think it's tough to liquidate positions right now because it's such a volatile environment, and you would be realizing some very hefty losses. So I'm not recommending our clients to liquidate their positions right now, but rather take advantage of any bear market rallies like we saw in the month of July to readjust portfolios. And I wouldn't be surprised, Guy, if we do get additional bear market rallies over the course of the next 6 to 12 months. So let's use those times to readjust, not in the peak of panic, which I think is what we are doing right now. So let's just add one more point, Guy, and I think that is when historically the equity market does catch a bid, and we do see a bit of a rally when the market has concluded that the Fed has reached its peak hikes. And I think we've gotten there. I don't think if they didn't hike 100 basis points this week, they're not going to. November, December could be 75 in November. My suspicion is that they do 50. I think the Fed is going to minimize or drop the cuts from here on out because inflation expectations are falling. Recession is a very imminent risk, and real inflation data is going to start to drop significantly.
Another headline, pound extending its declines, briefly trades below 110. I mean, really unbelievable moves. Hey, Catherine, when does EM credit and corporate credit start to tank? Those things haven't fallen out of bed yet with everything else happening. Why and when does it happen?
Excellent point, Alex, and this is something I've actually been talking with our institutional clients about for some time. We have not seen that wave of defaults or delayed payments in the high yield market or in the EM spectrum, and that's coming. So I would be very cautious on both high yield and emerging market debt. If we're going to be investing in fixed income, I would be looking at investment grade. Yes, it yields less, but there is no alternative, is no longer an investing option. So I would say be very careful. That is coming. And when it comes, high yield and emerging markets are so inextricably correlated in terms of their price action that emerging markets going to take a hit. So I would be very careful with regard to risk assets, especially on the below investment grade front or emerging market front.
Catherine, always great to catch up. Thank you for the analysis on what is an interesting day, which is part of an interesting week. Catherine Rooney Vera of Baltic, thank you very much indeed. As we've been speaking, KKR and investor letter going out today. A note to investors, the strategists there see a mild 2023 recession and the risk, Alex, of a Fed overshoot. It is certainly something that the market is now actively considering. How far will the Fed go? How much further will the Fed go than what is necessary? And how much damage potentially could that cause? That may be already being realized here in the UK. Still ahead, the UK announcing its biggest tax cuts since 1972. I can't really remember that. Maybe just. It's triggering a market meltdown, as you can see on the screen. More on that story next. This is Bloomberg.
It's time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Mercedes has begun stockpiling parts it makes using natural gas. That will keep production going for several weeks, even if Germany introduces drastic fuel rationing. Mercedes is building up supplies at factories in the US and China in case its German facilities have to go offline. Airbus is reaffirming its production targets, even though supply chain problems limit its ability to deliver jetliners on schedule. CEO Guillaume Faury says Airbus is standing by plans to build 75 of its flagship A320 family aircraft by 2025. It's also sticking with a reduced target of 700 deliveries across all of its jetliner models this year. And Apple Music will replace Pepsi as the presenter of the Super Bowl halftime show. Pepsi's had its name on the star-studded intermission since 2013. According to Sportico, Apple may have paid as much as $50 million a year for the 5-year deal. This year, more than 120 million viewers watched the halftime show. And that is your latest business flash. Alex?
All right, thanks so much, Ritika. So a historic giveaway. The UK government unveiling its biggest tax cut since 1972. UK bonds, pound plunging, markets pricing in more aggressive pace of tightening to offset the government's plan. Bloomberg's Lizzie Burden has been covering all of this. She joins us now at Westminster. Lizzie, walk us through the parts that the market objected to the most. There was a lot unveiled here.
Yes, Alex, well, you've got a raft of tax cuts. The Chancellor's trying to boost growth. Of course, we had the energy bailout that had already been announced. But the reason that this is such an economic gamble is, first of all, because markets reckon it's going to add to inflation. That's why traders are now pricing for 100 basis points from the Bank of England in November. Secondly, it's clearly going to necessitate a lot of borrowing. The Institute for Fiscal Studies says while it's going to add to borrowing, it won't necessarily stimulate growth significantly. And as you say, it's the biggest raft of tax cuts since 1972, but they're doing it at a time when borrowing costs are increasing because interest rates are going up. But it's also a political gamble. This is happening in a cost of living crisis. We're 2 years away from an election, not much time for Liz Truss to prove herself to the voters, and who in fact did not choose Liz Truss. Remember, the Tory membership chose her, and yet because of the tax cuts at the top end, let me read you some analysis from the Institute for Fiscal Studies. If you earn more than £155,000 a year, you win. Earn less, you lose. And if you earn more than £1 million a year, then you're going to be £40,000 a year better off because of these tax cuts. So frankly, our audience just got a whole lot richer.
Lizzie, they say they don't care about the markets. They say they don't care about the market reaction. Briefly, how long does that last?
Well, until the Chancellor realises that it's going to take the market's faith to pay for this. He needs gilts and sterling to fund this. You talked about the kindness of strangers earlier in this programme, that famous Mark Carney phrase. We spoke to Martin Wheel yesterday, former Bank of England policymaker. He says it's not the kindness of strangers, it's the vested interests of strangers.
Lizzie, great stuff. Thank you for the coverage. Lizzie Burden down at Westminster. This is Bloomberg.
about an hour into a very ugly U.S. trading session, but barely off the lows. Volume really high. Bloomberg's Abigail Doolittle tracking those moves. Abigail?
Good point on volume, Alex, because we are well off or well above the 20-day moving average. And this is the week. So to have high volume on the selling that we're seeing today, take a look at what it's relative to the decline of 4.5% on the week, including today. Any way you put it, slice and dice it, it is bearish. That SOX, that chip index, down even more, down 6%. Crude oil now breaking $80 per barrel. We, of course, earlier this year, we're talking about that parabolic uptrend that they typically don't sustain. It has now basically reversed in full, back below $80 per barrel, probably with more downside ahead. Crude oil, a risk asset, a sign of global growth, not doing so well today. And, of course, the big story, yields, bonds selling off, that 10-year yield, 2-year yield, both up about 25 basis points on the year, making everything else look more expensive and giving a lot of support, of course, for the dollar. When we take a look at the S&P 500 relative to the Dow Transports, because, of course, last week we pointed out the fact that the Dow Transports had broken below their June low, it seems very likely that we're going to see that again. In blue, we're looking at the S&P 500 on the year, ugly, down 22%, now back in a bear market if it ever left it. That Dow Transports, though, down even more, down almost 27%. This chart strongly suggests that you will see the S&P 500, the NASDAQ, the Russell 2000, all these big indexes break that June low. If that happens, is it a trapdoor? Where is support below? I would suggest that technically it's far below, probably somewhere closer to 3,000. That, of course, is a target that Mike Wilson over at Morgan Stanley has been talking about for quite some time, also talking about it in terms of bringing his earnings estimates in. This is the biggest area of volatility, though. This is really incredible because FX currencies, that's the foundational asset class of all. And if you take a look at what's happening on the week for the Bloomberg Dollar Index up 2%, the Dixie up 2.5%, of course having more exposure to the euro, showing how much weakness there is for the euro. But then if you also throw in the pound, and of course we have that plan today that's really going to create, is bringing the pound down as the government is going to need to borrow and borrow and borrow to support that plan. So I'm talking about parity for the pound. We've already seen that, of course, for the euro. And then this real growth pair, the Kiwi versus the yen, this speaks to yen's strength in a way that we can't see it against the dollar, down 3.2%. Both of these last two pairs, the worst since March of 2020. That's the kind of risk off. When we put it all together, it's pretty interesting picture, Guy. If we take a look at the VIX, which you would think would be sky high, the VIX relative to the bond index, that MOVE index, and the currency volatility index, this was March of 2020. All were way, way high. So right now we're looking at the MOVE index, interestingly not above its peak. Then we're looking at the currency index, both very high. There's the VIX. It suggests, I would say, and I've been talking to some of the experts on Options Insight about this, that we may have some more volatility ahead for stocks.
Certainly feels like there's the potential for some bumpiness. Abigail, thank you very much indeed. Let's continue the conversation about what's happening over here in Europe in a little bit more detail. We got the PMI data out a little bit earlier on. To be honest, the day didn't start particularly well and has progressively got worse. So we've had activity out for the Eurozone. We've got activity out for the UK. We've got individual country data that we need to be focusing in on as well. But basically, the takeaway, private activity in the Eurozone contracted for a third month. Obviously, this is driven by inflation, record inflation, and it's certainly having an impact in terms of the data. This is what we've seen today. So top line August, bottom line September. France actually looking relatively okay, but elsewhere, Germany is really being hit hard by what we're seeing with the energy crisis here in Europe. 46.9 to 45.9. These are the comp numbers. The Eurozone, that had a big effect on the Eurozone numbers. 48.9 down to 48.2. And then you look at the UK, 49.6 down to 48.4. These feel like recessionary numbers and certainly appear to portend some very significant economic slowdowns. You wonder what the October data are going to look like, particularly after the turbulence we're seeing now. Let's get an idea of what is happening here. Chris Williamson, of course, is the man to ask. He is the IHS Markit Chief Business Economist, putting together all of the data that we're looking at here on the screen. Chris, let's start off with the UK because that seems to be the epicenter of the action today. When I look at the PMI data, when I look at what has just been announced with the Chancellor, by the Chancellor, and look at the market reaction to it, is this an economy that, if it's not in recession, is certainly imminently heading for one?
Hi, Guy. Yeah, it looks like it's already in one. You had falling GDP in the second quarter, and the PMI data have deteriorated further in the third quarter. And the forward-looking indicators suggest it's going to get worse in the closing quarter of the year. So we're very much in recession at the moment, it seems, albeit only mild, but nevertheless, everything's turning into a more southerly direction when you look at business confidence, when you look at order inflows, as well as that headline activity numbers. It's definitely a contractionary picture that we've got in the UK at the moment.
So for the UK and Europe, are the same things moving it? Is it an inflation story? Is it a demand